Now, first up, the first warning shot that conditions in the unsecured lending market were deteriorating came with a trading update that African Bank gave the market in early May. The investment community was caught by surprise and the share price aggressively sold off following the news. With the dust now having settled, what do professional investors think the share and the wider banking industry have to offer? Tracy Brodziak, who runs the Old Mutual Financial Services Fund, joins us from Cape Town to share her insights. Tracy, it's a pleasure having you on the show. Let's just start with your thoughts on ABLE right now, taking that view that the dust has potentially settled.
Hi. Yes, I think it's going to be a very difficult 12 to 18 months. You've seen very strong growth in unsecured lending if you go back over the last 3 or 4 years. So in 2006, unsecured lending was sitting at about 40 billion rand. It's currently well over 120, 130 billion. Last year you were seeing growth rates of 50, 60%. That has slowed significantly and is now closer to about 20, and we expect that to slow even further to about 10 for the coming year. With that, you'll see an increase in bad debts coming through as the loan growth slows. So I think you actually haven't seen the worst of the bad debt cycle yet. I think the results coming up in the next 6 to 12 months will show a deteriorating trend, and you'll continue to see pressure from bad debt. So, I think the share prices have anticipated that, but I do think it's going to be a very difficult operating environment.
Tracy, just wanted to get your view here. Obviously, the share price has fallen, and some people thought at around 28, 29 Rand that the share price offered value then. Obviously, credit conditions deteriorating faster than everyone expected, and we've seen collateral damage to the share price of Capitec as well as the Big Four. So I just wanted to get your sense on where you thought the value kind of lies in the sector at the moment. Have you been buying African Bank and Capitec at these levels?
Okay, so if you look at ABLE, it's currently trading at about 16 Rand. I think if you look at the people, that what they've been most concerned about is really the funding model of African banks. So can you actually continue to get wholesale funding to fund the unsecured book? And I think what was very positive is that yesterday African Bank was able to place a 1 billion rand bond with institutional investors at a reasonable rate, which was JIBAR plus 275. So I think that was quite positive. But I do think that there is still quite a lot of regulatory uncertainty. The government is going to look at certain things such as credit life, garnishee orders. So, if you ask me at this price, I think it is good value, but I'm not sure. You may still get a better chance to buy it in the next 12 months.
Tracy, the top holding in your fund is Standard Bank. What is it about Standard Bank that has it so firmly at the top of your positioning?
Standard Bank is a very well diversified bank. It's obviously got good growth prospects in Africa. So I think all of that stands it in good stead. If you ask me what my favorite bank at the moment would be FirstRand. I know I don't have as much in the fund, but I actually can't buy more in the fund because I'm limited in terms of I can only buy 120% of the financial index. Okay. So I think at 27 Rand, I think FirstRand probably is a better bet.
Tracy, FirstRand's obviously had, it's been the banking group with the highest return on equity, and that's obviously, I guess, kind of justifies the valuation. But it's also had some pretty big news with the imminent departure of Michael Jordan from FNB itself. What's your sort of take on the people that are going to be running that bank and that franchise after he's left, even if he does stay on it in some role at FirstRand?
Yeah, it's obviously you don't enjoy seeing a very good leader leaving, but I think the positive with FirstRand is that they have a very big depth of management. So I think the people coming through are being given a chance, and I think they're very, very strong. So if you look at the various operating divisions, they're well run. They're good quality franchises. They've been gaining at the expense of their competitors, and it just shows you just the depth of experience and quality within the banking group.
How do you feel about the insurers out there at this moment in time, Tracy?
Well, the insurance has actually been probably the sector to be in within the financial services industry over the last 12 months. They've had a phenomenal run. And some of that was really from very cheap valuation levels. For example, if you look at a stock like Old Mutual, it had gone through difficulties in the financial crisis and had done a lot of restructuring, which the market has rewarded. I think if you look at the operating environment for life companies, it's improved. So I think that's quite positive. I think going forward there is concern on the state of the economy and what happens to persistency levels. So I think they're fairly stable, they've got good dividend yields, and I think that's quite attractive in this kind of environment.
Tracy, we obviously like to ask you kind of around some of the shares that fall into that specialty finance, and one of those is not Cannon Asset Managers, it's Coronation Asset Managers, the listed asset management business. It's had a great run. Where have you been interested in that company, and have you held it, or have you avoided that one? What's your sort of take on Coronation at the moment?
Well, I think Coronation is a fantastic share. It's done very, very well. And I think if you look at it, they've had a lot of tailwinds. So, for example, they have been gaining a lot of assets under management. They've had very strong performance, and all of that has really come through, and they've had strong earnings growth and good performance. I think our problem has just been that the valuation is relatively rich. So one of the things we look at is price to assets under management. And that's now trading at over 5%, which if you look at historic levels and you look globally, that is a relatively high percentage. While the environment is also positive for them, I can't see it derating, but it does bring some warning bells, especially if performance and or markets come under pressure.
Tracy, just looking at your Investec play, I see you've got both Investec PLC and Investec Limited within the portfolio. Can you just explain how you are playing that stock?
Sure. I mean, between the two, it's really at the point of entry which one is trading at a slightly lower level, because effectively they should trade at the same level. So it really just depended at the time of purchase. In terms of my view on Investec, again, that's been quite a nice recovery story in terms of they've been quite badly hit in bad debt, especially in the UK operations, and we think that that will unwind. They've also been growing the wealth management and asset management division strongly over the last while, which we think is quite positive. It has pulled back, so at about 70 Rand, I think it was getting closer to fair value. It has pulled back with the rest of the financial sector, and I think it is looking quite attractive. I'll probably pick up a bit more if it dropped more to the low 60s.
Tracy, obviously I can't resist the question. We saw the Investec Asset Management awarding their top people the opportunity to buy into, I think, 15% of that company, and they got shares directly in Investec Asset Management as opposed to the wider group. I wanted to see what you thought of that deal and whether or not your colleagues sitting at Investec Asset Management got a good deal there or not.
Well, I think, speaking as an investor, I think it's always quite positive if the people have a direct stake in what they can control. So in terms of the asset management, that's it's important that they actually have a stake in there. In terms of the pricing, I mean, that is a difficult one. If you look at globally, asset managers are trading on about 15, 16 PEs. The deal was done at about 10 or 11. But if you take a very long-term look, I don't think it's an unreasonable PE through cycles. You would always expect staff to get a slight discount. So, I think it's fairish.